At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Shares for beginners. Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
The way that we think about investing thematically is that you're looking to add the potential for outperformance, for growth.
Your alpha.
Exactly, some alpha. And the point of having it as a satellite or smaller allocation with your overall portfolio is sometimes, you don't necessarily get alpha. Sometimes, your thesis was wrong. So have that boring core in the middle, track what the market's doing, and then allocate in appropriately sized investments around the outsides as satellites, as we call them.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. This episode is proudly brought to you by Betashares ETFs. What are the metals that are essential to the energy transition revolution? And how can you access the royalties from some of your favourite recording artists? Joining me to talk about these investing themes is Cameron Gleeson from Betashares. G'day, Cameron.
G'day, Phil. Great to be here.
Thanks very much for coming over. So Cameron Gleeson is Senior Investment Strategist at Betashares ETFs. We're going to be talking about two ETFs, Royal, R-O-Y-L, and XMET, XMET. Let's dive right in. What are the metals that will be playing a major role in the sustainable energy transition?
What are known as the energy transition metals, or some people refer to them as energy transition materials, are a set of materials which are essentially really intrinsic to the electrification of things like transportation. Previously used an internal combustion engine car, we need to move towards electric vehicles. Also, the build out of capacity in renewable energies, wind power, solar and alike. And thirdly, really the investment required within the energy grid to enable efficient storage and transmission of electricity, given the nature of the way we generate power is going to be very different. This was sort of the genesis of the demand that we had for investors to provide exposure to the upstream providers of the metals required to build this out. So previously, we obviously talked about, we would consume a lot of fossil fuels. In fact, it's a series of metals. And just to give you the list there, copper, really critical metal for energy transmission and all forms of renewables and also electric vehicles, but also nickel, manganese, lithium, cobalt, silver, rare earths, graphite. I think I've named them all. Eight metals that currently are used in a range of...
so there's 8 discrete metals, is there? That
we're
talking about here?
For this ETF. Yeah. So, there's a lot of study done in this space as to the metals that are required, for example, to generate wind power or generate solar power. Now, the way that we approached this from an investment thesis was to look not just at the metals which are going to see sizable increase in demand from the energy transition, but also look at metals where there is some either natural or some sort of supply constraint. And we work with our index provider in identifying those metals. So there are obviously other metals that are going to be very important, such as zinc has some use cases in galvanizing wind turbines. The supply dynamics around zinc aren't quite as restrictive or tight, so price support for zinc doesn't look like it will be as strong as the level of price support you would need, for example, for lithium. So it was about basically building an investment case based on, firstly, the increase in demand, but also some constraint around supply, which means you've got price support. And if you're a producer, a miner of these materials, you're likely to see, strong revenue growth as demand goes up.
And these are called ETMs, aren't they?
Yeah.
Just generally, these 8 minerals are ETMs. Yeah,
that's right. That's right. So some people would describe a wider set of materials, but this is the set that we describe and define within the index methodology of this particular fund, the XMET, which is our Energy Transition Metals ETF.
Yeah. So what are your forecasts for the future demand for these metals? And how do you come to these forecasts? You must be crunching a lot of numbers.
There are a number of quite well-regarded groups that have produced forecasts for how much of each of these metals will be required. It's important to note that all of those forecasts, whether they're in-house ones that we've done or independent groups like Bloomberg NEF or, for example, the International Energy Agency do forecasts, all of those forecasts are based on particular assumptions as to the adoption of renewables, the adoption of electric vehicles. Most groups will do two forecasts. One is a stated policy scenario, and that's what we do when we say what government policies currently exist as to the requirement to transition to electric vehicles.
So we're going to be saying, the US is going to be saying whatever year it is where
yes, that's right.
Vehicles are going to be, a certain percentage are going to be electric. Yeah.
Exactly. So that's the low case in some senses, because that's what governments have already committed to. And then there's the high case, which is essentially aligned to the Paris Climate Agreement of no higher temperature change over 1.5 degrees. Mm-hmm. And the degree to which those materials are demanded is very variable. But even in the base case, you've got extremely high growth in demand. So take the use in 2020 versus 2040, look at the International Energy Agency forecasts. They see that lithium use in 2040 will have increased by a factor of between 15 to 40 times the figure in 2020. If I look at graphite or nickel or cobalt, clearly very important for electric batteries, a factor of increase of between sort of 7 to perhaps up to 20 times the use. And then we also see other materials like copper that have far smaller incremental increase, but there's also some interesting things going on in the supply side around copper, which means that we think that there's reason to believe there'll be strong price support in copper anyway, even though the increase isn't as great. So look, in any case, we're going to see enormous increase in the demand for these materials. And that's why these miners and producers are investing, are breaking new ground, building new mines to allow supply of materials into battery manufacturers, into electric vehicles, into renewable energy equipment manufacturers.
Some of these metals and minerals are coming from places where the governance issues are quite sad for some of the ways people are mining these things. And so you would think that that's going to be part of the transition as well, that these metals and minerals, we want to be mined in some place where we actually treat the people who are mining the minerals better than they currently are.
Yeah, I mean, that's right. And also another important point to make is that the carbon footprint from extractive industries like mining is generally quite high. It is important to note that if you look at that carbon footprint from mining some of these metals, you will generally find that on a net basis, the fact that the materials are used for renewables means on a net basis, product life cycle, you actually save carbon. But you're right, there are areas like the Congo that we've seen massive issues with artisanal, as it's called, artisanal cobalt mining. We also see issues around water consumption required for particular forms of lithium extraction.
Because lithium's a salt, isn't it? And sometimes it just has to be laid on the ground and dried out, doesn't it?
That's what. Yeah, there's two general.
There's two kinds.
Yeah, that's right. Exactly right. Two methods, and the one that's predominantly used in South America is essentially evaporation. So uses a lot of water. It's important to note in terms of the ETF, we obviously know that some people will be very focused on the ESG characteristics of this, and so we use some filters to filter out what are companies that have been marked as having severe controversy, and we also filter out companies that have a substantial amount of exposure in fossil fuels, because obviously some of these are diversified miners. They might be mining copper, cobalt, but they might also, have some sort of role to play in thermal coal. And so that was sort of important consideration for us.
Mm-hmm. Although a lot of those companies like BHP are divesting themselves of coal.
That's right.
But it still goes somewhere else, doesn't it?
Yeah, well, BHP's still got coal, so until they divest, then they won't qualify.
Yeah. So most ETFs are based on an index. What is the index that this ETF is based on?
The name of the index is the NASDAQ Sprott Energy Transition Materials Select Index.
Yeah.
Some of these index names are quite long-winded. The important point to note here is that there is a key party involved. So NASDAQ is the index provider. They're calculating the index every day. With ETFs, having an index makes it very efficient to manage that money. Sprott is a Canadian asset manager, and they're very active in the energy transition metal space and also in precious metals. They have listed a number of ETFs in combination with the NASDAQ in the States. They bring a real wealth of knowledge and insight into the energy transition space. one of the key elements of building any kind of ETF is ensuring that you've got true to label exposure. And what their role is essentially to identify the revenue exposure, or if you like, the exposure of each company in the mining space, and what degree is their revenue associated with each one of those 8 metals. Now, important to note, this is not an active fund. It's probably a question you might ask.
I was going to ask, is it active or passive? It's passive.
It is passive,
based on that index.
So it is important in certain thematic ETFs or certain sector ETFs to use an expert body, but our philosophy is that what their role is to identify all companies in that space. It's not to select which company within that space I prefer, because within our framework of providing an ETF, what we're obviously looking for is diversification. In this case, diversification across this selection of different metals. The role of Sprott is they are a selection party, and they identify companies that have exposure to various metals, and they have a very deep database of mining companies globally, and they can tell us what proportion of each company's revenue is attached to each of these particular metals. At that point, the index is entirely rules-based. So that's the data input that they're providing due to their expertise. Then the way we build the index is you can think of those 8 metals as 8 different buckets. And we try and fill those buckets with up to 6 miners or producers of each metal. Beyond that, we also have another bucket for diversified miners that have exposure to multiple metals. We also have another bucket for essentially recyclers of these metals, because part of the supply chain for energy transition materials is in fact going to be recycling. That'll be an increasingly important element.
And copper especially, isn't it? It's becoming increasingly important to recycle it as well, isn't it?
Copper, the real issue with copper is that the grade of reserves in large tier 1 copper mines is declining, and so supply is likely to drop off. So there is a need to, and copper is actually quite recyclable, so that's good, but there's a need to provide recycling there. But another important element is in the electric vehicle space, the recycling of the batteries, the lithium-ion batteries. And if you look at the regulations put out by the EU, they're in fact mandating that European automakers have a certain portion of that battery made from recycled battery elements. That industry of recycling electric car batteries isn't enormous at the moment, because most of these electric vehicles have only just hit the roads. We have to wait until those cars reach the end of their useful life, and then we see that as they're retired, those batteries get recycled. But that's all part of the picture. It's essentially the upstream supply of all these materials, because we know demand for these materials is huge, and we know that that supply is constrained. So from an investment standpoint, that's quite a good market dynamic for investing, and it's one that we expect to play out over the long run. This isn't going to be something that plays out over just the next year. This is a multi-decade thing.
Yeah, and it's also because they're commodities, the price is going to go up and down without any rhyme or reason many times, isn't it? I mean, and a lot of there's a lot of listeners who would have jumped on the lithium craze of the last few years, and they just buy individual lithium miners. Why not just invest in the miners themselves?
Yeah, that's an excellent question. One of the sort of
you wrote it almost.
One of the elements, if you look at, for example, lithium in isolation, is that we think, very long term that it's likely that we're going to see a deficit, because while there has been a lot of projects that are coming online, the growth in projects year on year, year after year, is just enormous. So longer term, we think it's quite a constructive picture. In the short term, we can see these sort of quite dramatic moves in that particular material. One reason you might think about investing across the suite of materials, if you take battery materials, right? Like, so the way that battery manufacturers have adapted over the last 10 years in terms of building batteries, the two things they're looking to optimize for are basically energy density and cost. If you look at cobalt has been an element that has become increasingly more expensive. Cobalt's very important for ensuring the battery's stable. But battery makers have managed to alter the chemistry to reduce the amount of cobalt in the battery, because they don't want to deal with the ESG issues with some cobalt from the Congo. Yeah, that's right. And they also want to ensure that they can produce that battery at a certain cost level. And so we see alternate chemistries competing in terms of the ratio of different materials used. So in some senses, investing across a group of companies across a range of those materials is likely to mean that no matter what happens to battery chemistry, you're likely to win or receive pretty good returns.
I suppose then it'd be very difficult for you to individually go, well, what's the composition of going to be for a battery next year?
Exactly.
And which company should I be in for there?
Exactly. Yeah. Right now, the way that most people think about batteries is that high nickel content, for example, is very good for energy density. However, there are alternate chemistries that prioritize a higher manganese content that are being worked on. So holding that sort of basket exposure means that you have less of that risk on a single chemistry technology.
And what about policy decisions? I mean, the Inflation Reduction Act, which I'm not sure about the naming of that particular policy, but there seems to be a lot of funding of ESG and new renewable technologies in that as well.
Yeah, that's an interesting one. The US Biden policy, the Inflation Reduction Act, I guess it would have been harder to get it through Congress if he called it the Green Energy Act.
Yeah.
So essentially, this includes a range of measures which were really designed to support the build-out of supply chains in energy transition materials and the build-out of a renewable energy industry in the United States, which is obviously strategically important because China has, in fact, really become the leader in a lot of these spaces. And one of the things you would argue Biden has tried to do is really, I think you could describe it as weaponizing the US consumer by allowing a consumer who wants to buy an electric vehicle to receive a tax credit. But that tax credit is based on the source material for the battery materials used in that electric vehicle. And so the source material must be sourced from a company that America has a free trade agreement from. And if some of that is sourced from China, well, then that tax credit goes away entirely.
Yeah.
So you can see where there's some, political...
There's some levers being pulled.
That's right. Yeah, geopolitical jostling.
Yeah.
Exactly right. And that's a real positive for, producers in friendly nation states. And we're also seeing, for example, the release of what was in the States, the US Critical Mineral Strategy, which has provided funding to a number of these producers. And Australia produced one of these critical mineral strategies just in the last sort of 6 months. And we've seen companies like Pilbara Minerals receive government funding, cheap government funding, to build out their capacity. So there's certainly some tailwinds from that side. And I don't think that that's a short-term, driver. I think we're going to continue to need much greater growth in supply, and so you'll see an encouragement from policy like that.
So can you talk about a couple of the constituent companies in this ETF? Who are the biggest ones?
So look, I mean, the index itself is designed to be diversified. So each stock in that index, a 6% stock cap is applied when we rebalance. And so generally speaking, the biggest names...
So one company can only take up 6% of the whole portfolio.
Yes, exactly right. On the rebalance date. In between, if that company
it can go up or down.
Outperforms, that will rebalance it back down. But some of the bigger names, for example, Freeport-McMoRan, which is the world's largest copper producer, US company there, produces most of its revenue from copper and has some of the lowest cost copper mines in the world. In Australia, there's a number of names. So, for example... IGO Limited, who has pretty significant nickel assets, also has a share of a lithium hydroxide plant, which has recently been commissioned in Kwinana in WA. Companies like Lynas or Syrah Resources, who operate in the graphite space and have the lowest cost graphite mine in outside of China. And then we'll also see other names from offshore. MP Materials Corp, a leader in rare earths and alike. And then even beyond that, if we talk to recyclers, there is a company that I think is quite interesting called Umicore, which is a Belgian metallurgy company who have really been a market leader in terms of battery recycling. So that forms part of the overall mix. It's interesting to note that while some of these companies are relatively dedicated to a single material, so, for example, lithium producers tend to be specialist lithium producers. There are others that are somewhat diversified that have exposure to whether it be, silver, copper, or whether it be, nickel, silver, copper, cobalt. Because sometimes in these mines, you're not just extracting a single material. There'll be multiple byproducts beyond the primary material extracted. But that gives you some sort of flavour for the overall mix of producers, I think.
Talk to me a little bit more about that Belgian company, the metallurgical one, because you sound particularly interested in that one.
Yeah.
What is it that interests you about it?
Oh, look, I mean, I just think like the way...
And they're doing batteries? Is it lithium batteries that they're recycling?
That's exactly right.
Yeah.
So if you look at the way they've embedded themselves in that ecosystem, they've formed strategic partnerships with automakers and with battery manufacturers. And look, I think I might have mentioned this earlier in the podcast, the EU has policy which is quite supportive of recycling. And so, the way that this looks like it may evolve is one of the big things that people worry about with their electric vehicle is what happens if my battery dies?
Yeah, where does it go?
Exactly. Is the car a write-off? Mm-hmm. Well, if you think about the way these arrangements can be structured, there is residual value in that battery. And so an automaker can give a guaranteed value for this car, or at least the battery, and replace the battery after a period of time if they have such an arrangement in place. And obviously there can be savings from recycling over extracting new ore, so that's very positive. And creating a sort of a closed loop strategic relationship with your manufacturer, your automaker, and the provider of the materials means that you can guarantee green credentials and also guarantee...
it's a virtuous cycle, isn't it?
Exactly, ESG credentials. Mm-hmm. And so they really are seen as a leader in that space. So that's I think it's just going to be a really interesting one to watch.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
This episode is proudly brought to you by Betashares ETFs. Okay, Cameron, so we're going to move on to the Royal ETF, ROYL. And I was particularly interested in this because I've got a background in music, and, I immediately saw royalties. You're going to be making money out of those royalty streams that artists...
I know, it's close to your heart, right?
It is very, very close to my heart. However, but it seems to be that it's not just music, is it? It's mining, music and pharma.
Yeah, and actually IT as well.
Oh, IT as well, yeah.
Yeah, that's right. Yeah. That's right, yeah. So the use of royalties to, either engaging in commercial relationships to help in financing solutions has been growing over the last 20 years. And also, I mean, we can talk specifically about music, the way that people have been consuming music has led to, shall we say, sort of a different business model, which is very much in line with it, with a royalties type business model.
Yeah, because we've heard of so many artists who've been selling their catalogue recently,
Yeah.
And I was always shocked that Bob Dylan's was like only $300 million and Bruce Springsteen, I think, was $500 million.
Interesting, yeah. And you remember the Bowie bonds from back in the day?
Oh, I sure do.
Yeah,
because they were the first ones, weren't they? The Bowie bonds. David Bowie.
That's right.
Monetised his catalogue very, very early in the piece.
Yeah, it probably only cost $2 million or something at the time. It probably would be a bargain now.
Yeah, that's right. Okay, we will get on to the music royalties, but how do royalties work in the mining sector?
Yeah, so, I mean, there's different types of royalties. One royalty that people might be familiar with is a finance royalty. And this is typically where you have a mining company, but this can apply to other areas like the R&D within the healthcare for new drugs, healthcare industry. But if you think about this from the context of a mining company, if I'm a small cap miner, I may not necessarily have the capital to basically develop my mine site. And developing a mine site can take years and years and years.
Yeah, it's years, decades almost sometimes.
That's right, that's right. So then having no cash flow means that financing that with debt can be prohibitive. So rather than using debt financing or equity financing, which will dilute my interest, one option I have available to me is to look for someone who's willing to provide financing but receive a royalty payment, which is often in the form of a proportion of the overall revenue, not the earnings, but the revenue generated from that ore when it's sold. So that's one model that's been used. Another model, which is a variant on that, is rather than taking revenue, receiving an offcut or a proportion of the ore or whatever that resource that's produced at a very heavily discounted price. is another way.
So you're not being paid in cash, you're being paid in ore.
Exactly. Getting paid in ore, but getting that ore quite cheaply. Mm-hmm. And then a third model, which is particularly widely used in the oil and gas field, is that there are companies that, in fact, own the land. Rather than providing financing to help, exploit that resource, they're providing basically that patch of shale land, so that a driller can come along and drill that, and they'll receive a payment for the fact that they own that land.
Mm-hmm. Like the Beverly Hillbillies with their oil.
Exactly. That's right. So
you get a gusher and you just sort of take a bit of a percentage of that gusher, but let someone else drill for it.
And then move to Beverly Hills, So they're the three sort of main types that are used specifically in the mining and the oil and gas sector.
Mm. Because you alluded to how mining can take a long time. And so investors who want to get royalties from these mines can be investing at all sorts of different stages, all the way from just a geological survey all the way through to ready to drill, can't they?
Yeah, that's right. And
they've got different characteristics as well, that stage, don't they?
That's right. And what we've actually seen with royalty companies over the last couple of years is they've actually been, when you have a royalty stream, which is where you're earning revenue, that's obviously generating cash flow. We've seen that there's been quite a lot of activity with mining companies discovering all sorts of royalty entitlements on their books, and they've in fact been looking to sell them off to realize value. So a lot of royalty companies have been spending the last couple of years actually investing and building their business, building their royalties book. And they're obviously, not thinking about what the royalty is worth today, but thinking about what that's worth once that mine comes, production comes online. Mm. And a couple of other advantages there in terms of the structure of royalties is that, firstly, you are absolving yourself of the operational risk of the mine site. So a mining company will really focus on operational excellence. How do they ensure that the mine is producing ore but keeping the costs low? By investing this way, you're taking exposure to the commodity price, but without that operational risk. But you can also get further upside when a mine increases its overall scope, or they realize that their size of the reserves are in fact much greater. So there's potential upside there beyond the original base case as that mine gets expanded. So there's a number of ways to win there.
And it's very similar for pharmaceuticals and biotech, isn't it? Because, again, it's a long time horizon. It can be really capital intensive. And this is where the royalty model plays out as well, isn't it?
Yeah, absolutely. Like we've got a company, for example, Royalty Pharma, that sits within our ETF, and they own royalty streams that are attached to some very well-known drugs that are very well used by consumers, and those royalty streams obviously do last for a very long time. But there is an upfront risk there, and that needs to be funded. That R&D development can obviously take years and go through many stages.
And it's not very capital intensive, is it? The royalty business doesn't involve a lot of capital, does it?
Yeah, so I guess you'd say it involves a degree of upfront capital in terms of the original investment, but working capital, if you think about the model, if I'm a royalties company, and I'll go back to the example of mining royalties, I actually don't need to really do anything once that mine's up and running. I don't need to employ anyone. I don't need to buy any diggers. I don't need to buy any mining equipment. And so, what I'm receiving is just a pure cash flow on that without needing to worry about any of that CapEx or OpEx. So, from a return on equity perspective, it's quite an attractive business.
And this business model, it works in such a similar way that you can actually put music companies. I mean, we're talking about, Universal and Warner's. They're very huge music companies. But really this model is similar enough to be able to plonk them into the same ETF, is it? Yeah,
so I'd almost say that if you think about the way royalties sort of evolved in the mining space, it was almost independent of what's happened in music.
Yeah, and because royalties, copyright has been around for 150 years, something like that.
Exactly right. Probably, as you'd be well aware, what's changed in music in particular has been the way that consumers consume, being connected to basically listening to a song, and that's led to a model which very much aligns to a royalty stream, and companies like Universal obviously and Warner and others, but also companies that operate within the IT space that specialize in royalties attached to the use of software, have a very similar model where there's intellectual property and the royalty stream is based on that intellectual property.
I was thinking of a joke about precious metals and gold and platinum records, but anyway.
That's not bad. That's not bad.
Not bad. When we're talking about a catalogue of music, an artist like Bruce Springsteen or Bob Dylan, they've written so much music, and copyright resides in many aspects of that music. And the record companies have it. There's the publishing, there's the mechanical royalties. I mean, I won't get stuck in the woods there, but it can get quite complicated, can't it?
Yeah. There's like, for example, if you think about what's the song? The classic example is the Dolly Parton song where she owns where there's the composition and there's the master recording that Whitney Houston did of I Will Always Love You. That's the one. Yeah. And just the way that that's broken up is very interesting. And as I understand it, also you can carve up that royalty stream between advertising uses.
Well, that's the other thing. Advertising use is a huge part of it as well. When a song is used in an advertising or as part of a movie soundtrack, that's going to suddenly generate a huge amount of royalties, isn't it?
Yeah. And it also has been interesting. I mean, we talked about it initially, but there have been a number of artists that were very big back in their day, and people using streaming services have rediscovered them and realised how good the quality of the music was. And the value of those particular back catalogues has just skyrocketed. I think one thing that's quite interesting, and this is probably a bit beyond the scope of anything that concerns this royalties ETF, is how do you think about the value of a particular songwriter's work today? How do you decide whether that's going to be classic and enduring, so therefore have this long tail of revenue attached to it?
Yeah.
Or is it going to be a flash in the pan?
Is Cardi B going to be worth this much money in 20 years' time?
Yeah. I hope not. I can give you one interesting stat, just some stuff I was reading in the so Universal Music. They were talking about the streaming services in the US being at about 80% penetration rate for videos or for TV.
Yeah.
So if you think Netflix,
that's 80% of the
about 80%
of the eyeballs watching.
Yeah, or consumers. Whereas it's only apparently music streaming incredibly only sits at 25%. Now, I think it must be a global figure.
Where else are they getting the music from?
Good question.
Yeah.
I guess there's probably people who are not using a paid service, paid subscription service.
Yeah.
Would be my guess.
Don't think anyone's buying CDs anymore, are they?
No, I doubt it. But I imagine some people would just like almost listen to, I don't know, YouTube for free or something like that.
Yeah, I guess so. Because there is a lot of music available there for free. But that's interesting too about Spotify, is how much of their revenue goes straight to copyright payments. And to me, I sort of look at Spotify and I go, how can they make money out of this? All the money's going to the artist, and how much is left over to run Spotify. However, it is like a very, very solid income stream.
Yeah, I guess for Spotify themselves, I mean, the fact that they own the consumer gives them a lot of market power. And, I kind of worry about the artist, really. Like, what are they left with? And you'd know much more about that myself. But
yeah. Well, I think an artist gets, 1 million streams is worth $5,000 US for an artist on Spotify.
Doesn't sound like a lot.
No. You got to be doing a lot of streams, that's right.
Yeah.
Okay, we're looking at these. These are thematic ETFs, and possibly not a good idea to have them as core of your ETF. How should investors be considering these as part of their portfolios?
Yeah, it's a very good point. We do think we're an ETF provider. We provide a wide range of ETFs. And the focus of most of our conversation with investors is those low-cost core building blocks. These are, as you mentioned, thematic ETFs. The way that we think about investing thematically is that you're looking to add the potential for outperformance, for growth.
Your alpha.
Exactly, some alpha. And the point of having it as a satellite or smaller allocation with your overall portfolio is sometimes, you don't necessarily get alpha. Sometimes, your thesis was wrong. So have that boring core in the middle, track what the market's doing, and then allocate in appropriately sized investments around the outsides as satellites, as we call them. One interesting thing about thematic ETFs or thematic investing generally is that quite often because the exposure, if it's true to label, if it really is a exposure to energy transition metals or to royalties companies, the degree of correlation or the degree to which it moves in the same way as the overall market can be quite low. So it can actually, if you're not allocating too much to one of these thematic ETFs, can actually really add in terms of risk-adjusted returns, or in effect, lower the volatility or riskiness of your overall portfolio. You don't want to allocate 50% to one of these funds because that would be quite volatile. But sizing it at, and I don't want to give,
we don't want to give any advice.
I'll call this is general in nature only, no personal advice, but an allocation of perhaps 4%, it might be appropriate for your circumstances, might be. And might lower the overall portfolio volatility because of the way that fund acts so differently to the broad market.
So I've got to ask you, happy to tackle a couple of listeners' questions?
Okay,
Yeah, okay. So we've had a listener question. Thank you, Matthew Donato, and thank you very much for the kind words you've said about the podcast. Matthew's going through and listening to every episode at the moment as we speak.
Oh, great.
And he wanted to, and I'd mentioned that you'd be coming on, and he had a couple of questions about ETFs. And one was, he wanted to understand about the net asset value, or the NAV, N-A-V, and how to assess it of an ETF.
Yeah, so your net asset value is essentially the value of one unit in that fund. So what is the unit price? If you're thinking about it, the equivalent for a single share, what's the share price of BHP? That's the way you would sort of think of the underlying value of one unit of an ETF. It's calculated daily at the end of the day at close, but on market in between closes, the amount that you trade will be relatively highly related to that NAV. It'll vary with intraday with market movements.
Yeah, it's never going to deviate very much from the net asset value, is it?
Yeah, so it shouldn't deviate very much. It'll, what will dictate that is, events that happen intraday. But generally speaking, ETFs are relatively efficient, and generally speaking have very tight bid-ask spreads. So they tend to trade around what we'd call the intraday NAV, which is a live calculation as to what the value of that fund is at that point in time.
Maybe you could describe like an ASX 200 ETF. How that works.
That's a great idea. Yeah. So the net asset value, let's talk about it that way. If we think about the value of a fund, and let's use our A200 fund, which is our Betashares Australia 200 fund, it's basically the 200 largest stocks, market capitalisation weighted. If we think of the
that's about the number of shares on issue, multiplied by the price of those shares, basically, isn't it?
Yeah. So
and that can change all the time.
They do. Yeah. So if that's 200 stocks, the holdings within that fund will be based on the proportion of each of those stocks within the index. Each of those stocks will vary on a daily basis, and so imagine you had a single stock that was half of the overall index. Not that that's
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes, only algorithms.
At Staples Business Advantage, furnishing your office is easy. And with the best warranty in the business, we're committed to you now and down the road.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
the case, but just to simplify things.
Well, the miners and the big banks.
but yeah, you're not quite. But yeah, so if that single stock doubled in value from one day to the next, then and that stock was half the overall index, and the overall index's NAV would go up by about 25%, half of 50%.
Yeah.
But it really is the accumulation of each of the valuations of the individual stocks that are held within that ETF.
Okay, and the other question is, what's the difference between hedged and unhedged ETFs?
Yeah, so when people refer to hedged and unhedged, they're typically talking about currency hedging. Now, a unhedged ETF or an ETF without currency hedging is typically a global ETF, so it may well be global equities. And because I don't have any hedging in place, one of the factors that will influence the performance of my ETF would be the value of the US dollar versus other global currencies. So let's talk about this within the context of NDQ, which is our NASDAQ 100 ETF, which is all US listed equities. Now, for this fund, if the value of each stock in that index doesn't change overnight, but if the US dollar was to appreciate by 10% against the Australian dollar, then for my Australian investment in NDQ, the value of that NAV will go up by 10%. So what I have there is an exposure which has changed because of the currency, not because of the value of those stocks in their natural currency. Now, for a lot of people, that's quite an attractive way of investing. They prefer to invest on an unhedged basis. Some people would say that that provides extra diversification. Other people might prefer to invest taking out that currency risk. And so what a fund manager will attempt to do here is that they'll hold, say, $100 million worth of stocks in the NASDAQ, but they'll also have a hedge such that if the value of the US dollar appreciates by 10%, the currency hedge in this case will lose, the equivalent 10% of the value. So you're maintaining direct exposure to the US dollar performance of the underlying stocks.
So it's just basically on a one-for-one basis between the Australian dollar and the US dollar.
That's right. That's right. So you can look at the US NASDAQ performance and understand that's roughly speaking what you're getting exposure to.
Yeah. Okay, Matthew, thank you very much for those questions. Cameron, thank you very much. I've really enjoyed talking to you today.
Thanks, Phil.
Yeah,
that was great.
Thanks very much. Okay.
See you next time.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.
This episode has been proudly brought to you by Betashares ETFs.